now, and let me welcome now on the show Adrian Mowat, emerging markets equity strategist, joining us on the show. Hi, Adrian. Morning, and good to be speaking with you. And firstly, what do you make of the Powell's latest commentary, where he's actually flagging off that seems like that the U.S. markets are fairly highly valued? What's your sense over there?
It remains a very challenging position for the FOMC at this point in time. You've got some evidence of a slowdown, particularly in the labor market data, but then some concern about that data as the Trump administration changes people at the organization that puts together that data. Then you've got an equity market that seems to be bounding ahead, suggesting a strong economy, although I would caution people in just saying, look, the S&P's up and it means that people are confident on the economy. If you go into the sectors that are more economically sensitive to the weakening data, they've been doing poorly. The sectors that are influenced by the Trump administration policies, such as pharmaceuticals, have done very poorly. So I still think we've got an S&P which is telling us more about the hype on AI rather than the US economy. And back to the US economy, which is really what matters to the Fed, is the Fed has data which shows that the labor market is weakening, but the inflation numbers still remain above their target. And this will remain a very challenging environment for the FOMC. And I don't think the market should be confident about forecasting numerous more cuts in the Fed funds rate in 2025. It might be a situation where the Fed doesn't cut anymore if these inflation numbers remain stubborn.
All right, that's a take. When it comes to the US markets, yes, of course, these AI-related stocks having a great run-up of late. But Adrian, what's the sentiment that you are catching hold of when it comes to emerging markets and specifically India? Because we do have a lot of the factors at play with respect to giving more income in the hands of the people, and that's indeed helping fueling the rally of late. But what's the sentiment looking like?
So for non-US markets, the environment is significantly better than we've seen for many years. So we have a weakening US dollar. We have a desire to diversify from expensive US equity markets. We have a Fed that is cutting rates, even if maybe more gradually than the market expected. So that is a good environment for global equities, and European equities are doing very well. European banks have had a spectacular year. But we're also seeing a flow into emerging markets. Now, India is quite a significant laggard within the EM space, with markets like China really being the main lead here. And I do think, China has some specific tech-related areas that look very interesting to investors, but they've also got a very good share buyback, shareholder value policy in place with rising dividends, buybacks, etc. Your commentator before was discussing what Rajiv was saying. Rajiv and his team put out a report looking at shareholder value activities within EM, which have picked up quite substantially, but that is very focused on markets like China and much less so on India.
Sure. But Adrian, just wondering in terms of a trigger point, what will really dictate the world? Is it, while it's all interlinked, but it's really about tariff and the impact of it on the world, which seems like is headed in for a slowdown pretty much all across? Or is it more to do with Fed price action and then how the dollar behaves post that?
When we think about the tariff issue, you could say, look, okay, tariffs get put in place, markets efficiently price that. The problem that businesses are having is that the tariff regime is still not finalized. The Trump administration came out with many executive orders. We had the H-1B visa story of this week. This is a very difficult environment to plan, and I think that is resulting in very weak capital expenditure by the business community. I talked about how badly pharma have been doing. Pharma companies have been announcing cutting back in investments in R&D, etc. So to me, it's the impact that this has on capital spending. So what we have in an environment, when you look at the capital spending statistics in the United States, they're heavily focused on AI spending, spending on data centers, spending on power equipment that's required for these data centers. So it looks quite imbalanced. So to me, tariffs are just a story of policy is changing rapidly. In that environment, businesses tend to be defensive and cut back on investment.
So in this kind of environment, Adrian, when one is seeing pretty much all asset classes bubble up, right? What do you think is going to give way first? Is it going to be equities or is it going to be largely gold?
So I mean, it's a good question. I think what it's going. You say all classes are doing well. The bond market has been very noisy this year. Now, I appreciate that 10-year bond yields are back at 4.1 and have been as high as 4.5. But then if you start to look at what's going on in credit markets, there's concern about a big auto supply company getting into difficulty in the United States. So we're likely to see credit spreads moving wider. Other bond markets are struggling as people look at fiscal positions. So what I think we're seeing is we're seeing a movement out of a very large capital market, which is the bond market, into other asset classes. And those other asset classes can be equities, but clearly have been things like gold as well as cryptocurrency. And I don't see that changing near term because I think the outlook for bond markets still remains very uncertain.
No, the reason why I asked was because typically by nature, equities and gold work in a polarized manner wherein one is risk on and the other is risk off. So I was just wondering as to how is it that both are pretty much at an all-time peak?
I think, I believe it's what I was talking about, money moving out of bond markets and looking at alternative places to park that money, and gold's been a beneficiary of that. I mean, the problem in discussing gold is that, we've had a lovely bull market in gold over the last 2 years. But if as a strategist going back over many decades, it's really difficult to work out what actually drives gold. What is it correlated to? Gold prices were going up even when the Fed was raising rates. That normally isn't what happens. So I think we've got a slightly unique situation where people are trying to diversify out of the US dollar, diversify out of bond markets. The gold market is actually quite a small market relative to other capital markets, as are even crypto in terms of their proper free float. And so you get these outsized moves.
Okay. Adrian, great to get in that insight from you. Thanks for your time as always.